Right now, shares of Datavault AI Inc., ticker DVLT, are trading at $1.73, and this is not a quiet day. The stock is up a staggering 33 cents, or 24.22% in live intraday trading on Monday, November 10, 2025. The volume is explosive, already topping 62 million shares, right near its daily average, signaling an all-out battle for this company's future. Now, many investors might glance at a sub-$2 stock in the artificial intelligence space and dismiss it as just another high-risk speculative name bouncing around in the wake of giants like Nvidia stock. The common expectation is that these small-cap names are just noise, but the reality of today's 24% surge is far more specific and far more dramatic. This isn't just random hype, this is a counteroffensive. The fuse for today's explosion was lit this morning when Datavault AI announced it has officially filed a lawsuit in federal court against the short seller Wolfpack Research. This legal action stems from a report Wolfpack published on October 31, which Datavault claims was filled with false, misleading, and defamatory statements designed to tank the stock for Wolfpack's own profit. Today's move is the market's reaction, a violent unwinding of short positions and a surge of new speculation. The prevailing narrative for DVLT, especially over the last couple of weeks, has been one of distress. The Wolfpack report hit the company hard. We saw the stock bleed out, falling over 8% in the past week alone. For anyone holding this name in their Fidelity or Robinhood account, it looked like the short sellers were winning. And the expectation was that this company, which operates in the complex world of data monetization, was in serious trouble. The general belief was that this was a small, cash-burning entity that couldn't defend itself. But today, the reality is that DVLT is not going down quietly. By filing this lawsuit, management has drawn a line in the sand. The market is now being forced to ask a different question. Was Wolfpack right, or is this a deeply undervalued company that just got a chance to clear its name and squeeze the shorts? This 24% spike isn't about fundamentals in the traditional sense. It's about a war for the narrative, and the longs are launching a major assault. This kind of volatility is exactly what traders using platforms like Interactive Brokers look for, where execution speed on a stock moving this fast is critical. This lawsuit is the capstone on what has been an absolutely dizzying period of press releases from the company, almost as if they are trying to fight the short report with a flood of positive news. In just the last few weeks, Datavault has announced a partnership with Max International AG to launch a Swiss digital real-world asset exchange. They've also announced a $10 million exclusive licensing agreement with Scilex Holding Company for the tokenization of genomic and DNA data, a massive and potentially very lucrative field. As if that wasn't enough, they've also publicized partnerships with Rodney's Comedy Club to copyright jokes in real time, and another with Music Dash and NF Hits to transform music data tracking. From an outside perspective, it's a whirlwind. The expectation is that all this news should propel the stock. The reality, until today, was that the short sellers' narrative was overpowering all of it. Today's lawsuit, however, seems to be the one catalyst that has finally broken the bearish momentum and forced the market to pay attention. It shifts the conversation from, are these partnerships real, to, can the company prove the short seller lied? Let's dig into the recent trading patterns because they tell the real story. The 62 million shares in volume today is not normal. It's a clear sign of institutional machines, retail traders on apps like SoFi Invest, and short sellers all colliding at once. Before today, the stock was weak, breaking below key moving averages as the market digested the Wolfpack report. This 24% gain instantly shatters that downtrend. It reclaims technical levels, and more importantly, it puts intense pressure on anyone who shorted the stock in the 130s or 140s, expecting it to go to zero. Now those shorts are underwater and may be forced to buy back, adding even more fuel to this fire. This is a classic short squeeze setup, triggered by an unexpected legal catalyst. But it's happening against a backdrop of a cooling AI sector. While giants like Apple stock and Tesla stock are figuring out their own AI strategies, the pure-play speculative AI names have faced a broader market rotation and profit-taking. Investors are growing wary of valuations that have outpaced fundamentals. DVLT's move today is in direct defiance of that broader sector trend, making it even more notable. So, who is this company that finds itself at the center of such a dramatic fight? Datavault AI, at its core, is a Web 3.0 infrastructure company. This is where many investors get confused. They hear AI and think of something like ChatGPT. Datavault's business is far more specific. It's built on the idea of data monetization. The company has two main divisions. The first is its data science arm, which provides a cloud-based platform for what it calls data valuation, tokenization, and monetization. The idea is that companies have vast, unused mountains of data, and Datavault's platform can help them assign a real monetary value to that data, turn it into a tradable digital asset, a token, and then sell or license it on an exchange. The second division is acoustic science, which is even more abstract. It includes a patented technology called ADIO, which uses inaudible data over sound tones to trigger transactions or verify identity, for example, at a live event or through a broadcast. Their partnerships, like the one with the Comedy Club to copyright jokes in real time, are attempts to show real-world applications of this complex technology. They're essentially trying to build the picks and shovels for a new economy based on tokenizing real-world assets, from genomic data to music royalties. Now, we must confront the other side of this story, the financial reality that likely attracted the short sellers in the first place. This is the tension that defines DVLT. The company's second quarter 2025 earnings report, filed in August, showed revenue of just $1.74 million. Against that, the company posted a net income loss of over $37 million. The profit margin is reported to be an almost unbelievable negative 1,545%. This is a company that is burning cash at an astronomical rate. This is the reality. The expectation set by the press releases is of high-growth tech firm. The reality set by the SEC filings is of a business that is spending far, far more than it makes. This is where the short sellers build their case. They see the aggressive news flow, the complex and hard-to-understand technology, and the massive cash burn, and they bet that it's all a house of cards. Making matters more concerning is the reported insider and institutional activity. Recent filings show very low institutional ownership, sitting at just over 2% of the float. This is not a stock that big Fidelity mutual funds or pension plans are buying. In fact, filings from the last 6 months have shown multiple instances of insider sales, including from the CEO Nathaniel Bradley. While the sales weren't massive, you never want to see insiders selling shares in a company they claim is on the verge of a breakthrough. This brings up the most critical risk for anyone doing their self-investing: dilution. To fund its operations and that massive cash burn, the company has to get capital from somewhere. The data shows that total shares outstanding have grown by a staggering 3,501% in the past year. That is massive, substantial dilution, as one report called it. It means that even if the company succeeds, each share represents a much, much smaller piece of the pie. This creates the ultimate high-stakes scenario. What is the future outlook? On one hand, you have the bull case. In this scenario, the lawsuit against Wolfpack Research is successful. It not only vindicates the company, but forces a catastrophic squeeze on all short sellers, potentially sending the stock flying. In this future, the partnerships are real and begin to generate significant revenue. The Scilex deal for $10 million is just the start, and the Swiss digital RWA exchange becomes a major hub for a multi-trillion-dollar tokenization market. The company secures more funding, the cash burn stabilizes, and this $1.73 stock is looked back on as the bottom. The company's investment in its complex data over sound and tokenization platforms pays off, and it becomes a key player in the Web 3.0 infrastructure, a name mentioned alongside other tech innovators. On the other hand, there is the bear case, the one Wolfpack is betting on. In this scenario, the lawsuit is a desperate, expensive distraction. It's a PR move designed to create a one-day pop like the one we are seeing, so the company can raise more capital at a slightly higher price, further diluting shareholders. This is the reality. The cash burn continues, the partnerships fail to generate meaningful revenue, and the insiders keep selling. The 3,501% dilution is just the beginning. The stock may be up 24% today, but it's just a dead cat bounce in a long-term downtrend to zero. Retail traders who pile in on Robinhood or SoFi Invest today, chasing the squeeze, are left holding the bag. The company, unable to fund its operations, eventually